I'll share.
And our next guest speaker, Yonah Weiss, uh, he'll be speaking on caste segregation in multifamily space. So with that, Yonah, you can take it from here.
Awesome. Great. Thanks so much. Everyone see my screen over here. Got the truth about depreciation and cost segregation. Grateful to be here. It is a topic that not too many people are familiar with. And so what I'd love to do is just open up the chat if you would. Hey, Sean, great to see so many familiar faces here as well. If you would open up the chat, and if you're watching this in the recording, you'll just have to answer it yourself. But I'd love to get a feel for what is your familiarity of cost segregation. So write the number 1, 2, 3, or 4. I'm going to tell you what those numbers represent, so don't write it yet. But write the number 1 if this is the first time you ever heard of cost segregation. So number 1, if this is the first time you ever heard of it. Number 2 is if you've heard of it before, maybe familiar with it, but don't really know much about it, or maybe know just a remedial amount. That's totally fine. That's what we're here today to learn. Number 3 is going to be if you are actually pretty familiar with it, know it well, and actually have used the service before cost seg. So not seeing anyone write 1, 2, 3, or 4. Oh, there we go. We got a number 2. So someone is paying attention. Again, 1, 2, 3, or 4. 1, if this is the first time you've ever heard of it. 2, if you heard the words before but don't really know much about it. Number 3, if you actually know very well, have used it before. And then finally, number 4, if really you're the cost seg king, and I'm going to hand the mic over to you and stop sharing my screen. So we got a couple 3s. That's great to see people who actually have used it before and have a pretty good knowledge of it. It's important to realize that, I've spoken to thousands of people about this, and literally actually thousands of accountants as well. And believe it or not, and Mark is a happy Madison Specs customer. Well, thank you for your business. I appreciate it. Many accountants, regardless of whether they're involved in real estate or not, most accountants have no idea what cost segregation is, or even use it, or not just use it, but really understand it. And that should be shocking to a lot of us. But unfortunately, that is just the case. So I'm going to share start the slideshow over here. There we go. From the beginning, I just got to switch the screens. There we go. Okay, and I'm going to keep the chat open here because I do want to see if anyone is actually paying attention. I'm going to ask questions throughout, and please do ask me questions throughout as well because I love to answer those on the fly. But we're going to, where's the spotlight? Can I use the spotlight here? Okay, there we go. We got a spotlight, and now we're ready to go. My name is Yonah Weiss. Like I said, I work for the biggest national company, cost segregation, called Madison Specs, part of a larger company, but we're going to break down what depreciation is today, what cost segregation is. Depreciation, before we get into it, we're going to also talk about, I'd like to tell you what I'm going to tell you. Okay. We're going to learn about what we're going to learn today. What are the benefits of doing it? Also, we're going to learn the downsides. At the very end, if you stick to the end, you have to wait all the way to the end to find the what's called depreciation recapture. We're going to hit all of that stuff. What's bonus depreciation? It's actually making the news. There's some really important votes going on in Congress next week that might change that. Who should be doing a cost seg? When is the best time? What's a real estate professional? We're going to talk about different asset classes. Yes, this is the multifamily event, but you can actually do costing on any type of property whatsoever. So we're going to talk about those different eligible property types and which one is most beneficial. So in short, depreciation is a borrowed term. You have to remember this. Depreciation is not what it sounds like, right? It sounds like your property is going down in value. Funny story. Anyone here active on Bigger Pockets? If you checked out the Bigger Pockets forum before, just write BP in the chat. If you've been active on the Bigger Pockets forum, I'm sure you come across a lot of different topics. And many years ago, they created a glossary of terms, right? Commercial real estate and real estate in general has so much jargon, so many terms and acronyms, LTV and cap rates and STR. And, those are just 3, but there's a lot out there, right? What do these terms mean? And so they created a glossary to, you can hover over different words in the forum and it will bring you straight to that glossary just to learn what all the terminology is. One of the things in the glossary was depreciation. And guess what it said? Obviously, as soon as they came out with the glossary, I wanted to see if they had anything tax related. Depreciation, it said the opposite of appreciation. That's right. Actually, that's wrong. That's what it said, but that is completely wrong. Depreciation does not mean the opposite of appreciation. So I reached out to Mendy Jensen, who runs the Bigger Pockets, forums, and the glossary, and gave her a screenshot, and she was shocked that that's what it said. She immediately changed it because it's a borrowed term. Depreciation does not mean in real estate something going down in value. It's the name of a tax deduction that allows you to deduct the value of your property as if it were going down in value, but it's not intrinsic to the property because this starts over every time the property changes hands. So you need to depreciate your property over a 39-year schedule if it's a commercial, or a 27.5-year schedule for residential, including multifamily. Multifamily is considered residential for tax purposes, even though from a lending perspective, there's different rules with 4 units or above, et cetera, are considered commercial. That being said, this again, 39 or 27.5 starts over every time the property changes hands. Okay, so if you buy a property and it's based on your purchase price, and you can literally, like I said, deduct the entire amount besides for land from your taxes. And this is why depreciation, why real estate is considered such a tax advantaged investment, because of depreciation. Now, cost segregation is an advanced form of depreciation. That's all it is. It's a fancy name of saying breaking down the property into different categories, that some things depreciate on a 5 or 7 or 15-year schedule. So we're accelerating depreciation. But that's all it is. It's just depreciation. So don't be confused. So just to show you a quick example of what this looks like, let's say you buy a property for $1 million and you're going to allocate a certain amount to land. Land value is different depending on the type of property, depending on the location, but the national average is about 15%. So we're just going to use that value here and say our depreciable basis, the amount we can deduct over this 27.5-year period, is $850,000. Now, this is not dependent on how much money you actually put down or how much money you put into the property. It's based on the purchase price. So you can buy a property with 10% down or 20% down payment, or with seller financing with 0% down. In all those cases, you're able to deduct the full purchase price. Okay. So in our case, $850,000, maybe they only put down $10,000, $100,000, 10% to buy this property. Nevertheless, they can deduct this whole thing again over this long period of time. So let's take our straight line depreciation numbers. If it's a commercial property, remember 39 years, it's $21,000. If it's a residential property, about $31,000, $30,000 just to keep it round every single year. That's called straight line residential depreciation. Now, if you make from your property, your net operating income is, let's say, $50,000. That means you immediately deduct $30,000 from that and are only taxed on the remaining $20,000. Okay. And that's considered passive income and it's taxed at a different rate. However, what we're dealing with here is cost segregation that allows you to accelerate certain components. And just to kind of show you the numbers ahead of time, we're going to get to the detailed breakdown of how this actually works out. But on average, for a multifamily property, it's about 28% is going to be allocated to these faster categories. So 5-year property, this can include anything in the interior. And again, in the next couple of slides, we're going to see what those things are. About 20%, again, that's $170,000, and 15-year property, about 8%, 15 years land improvements, things that are outside the property. And these are accelerated depreciation components of the property. And we're taking, again, a total of $238,000 of extra depreciation during these earlier years. Now, that's a lot better than taking $30,000 deduction in the first year. And that's why we can see that cost segregation is an incredible tax strategy. It's a tool that essentially increases your cash flow by paying less. Now, in our case, where the guy was making $50,000 from the property, if you were to take with bonus depreciation this lump sum of $238,000 in the first year, well, number one, you wiped out your tax liability from that property of $50,000, but you're still remaining with this extra $170,000 or so of deductions. Now, what do you do with that? Okay, it is not lost. Okay, you can actually use it in certain cases. And we'll get to these examples later on. If you're a real estate professional, you can use that extra deductions against any other source of income you have. If you're not a real estate professional, you can use that against any other source of passive income, any other rental property, rental income you have, or passive gains from the sale of any rental properties. So it is not all lost. It is actually a great tool, regardless of whether you're a real estate professional or not. But to maximize this, as we're going to see later, being a real estate professional gives you the maximum benefit of depreciation. So what is actually a cost? And we talked about some numbers, but what is it actually? Like, how does this actually work? Think about it like an engineering appraisal of the property, where we're breaking down, according to the tax code, every component of the property depreciates differently. And there's really main categories. So the main two categories, and we're going to see it in the next slide, are 5-year and 15-year. But the engineer comes and looks at every component, takes pictures, measurements, videos, etc., identifies what those properties are, what those components, those assets are that are faster depreciation. We're reclassifying them and therefore creating a schedule of deductions that allows you to take those at a faster rate. So we talked about land doesn't depreciate. We talked about the building that's on a 27.5 or 39-year schedule. Those are the main two things. Okay. So most properties are going to be the majority of the depreciation is going to be found in the structural components of the property, like the building, the roof, the walls, the foundation, the doors, windows, infrastructure like main, plumbing, and electric. All of that is considered infrastructure. All that depreciates on a 27.5-year schedule. But these main two other categories here are 5-year personal tangible property and 15-year land improvements. And this can be, like I said earlier, a significant portion. Think about stuff like appliances or furniture, equipment. All of that makes sense, right? It's movable. Obviously, it depreciates a different schedule, but even stuff like, millwork or flooring, carpeting, ceiling fans, shelving, countertops, cabinets, all this stuff, window treatments, all of it and more depreciates on a faster 5-year schedule. And we're able to take the value of those deductions at a fast rate. And like I said, can be, over 20% in many cases. The 15-year is land improvements. And this can be anything that's outside. Now, again, land itself does not depreciate, but anything on top of the land does, like pavement, concrete, landscaping. If you have a swimming pool or playground equipment, the retaining walls, signage, all that stuff outside depreciates on a 15-year schedule. It doesn't seem like, so great because, yes, you're accelerating it, more than half. But when we come to talk about bonus depreciation, which is going to allow you to take these deductions in the first year, that is going to be huge. Okay. We're going to take a lump sum of this. So don't forget about the land improvements. That's actually a huge factor that makes the difference between one property having 20% or another property having 30% of those depreciation deductions. We have Andrew asked a question here, and we're going to get to that in a little bit. Can a non-real estate investor use depreciation shelter non-real estate passive income? We're going to get to that shortly, of what's going to be considered passive income, what's going to be considered active income. But it's an excellent question because we need to know this. There's a lot of information out there, people talking about, oh, you can deduct this bonus depreciation and you invest in my deal and you're going to get, bonus depreciation, etc. Well, is that going to be beneficial? Can you actually use it or not? So we're going to talk all about that. So let's keep moving on. What are the benefits I know there's a lot of people kind of joined a little bit late. So we're going to cover this just to kind of recap what we're doing with cost segregation depreciation. It reduces our tax liability. Okay. We're not creating new deductions out of thin air. What we're doing is reducing our tax liability. That's going to increase our cash flow because the time value of money. Okay. Time value of money means if a dollar today is worth more than a dollar a year from now or 5 years from now. And that's because what you can do with that money, instead of paying the IRS, how can we legally reduce our tax liability and use that money to reinvest and create more wealth by not paying taxes? I mean, it's simply put, but that's how real estate investors do it. And we're going to talk about bonus depreciation. This is something that gets overlooked a lot, is who should actually be doing this, right? And we talked about the passive deduction. We're going to talk a little bit more about that, about passive income. But what types of property? Does it matter if I own it in my personal name? It doesn't matter if I own it in a corporation or an LLC. It does not make a difference. The only types of people that cannot benefit from a cost seg study or depreciation in general is if it's a non-taxable entity. For example, a nonprofit organization or a government entity that is non-taxable, or a retirement account. Certain types of retirement accounts. I'm sure there is an expert that's going to be speaking about that at this summit, at this conference. I highly recommend everyone attending that because I don't know who it is, but retirement accounts are extremely important when it comes to real estate investing. A lot of people have these retirement accounts and they're just sitting there and the money's kind of stuck. You can reinvest that. You can self-direct that. However, when you do self-direct an IRA or a 401k, what's sometimes called a QRP, a qualified retirement plan, you are limited because it's a tax shelter, which means you cannot, in many cases, use depreciation to offset any of the income that's coming through that. So just think about that. If you are investing in a deal and they're saying, oh, you're going to get depreciation, but you're investing through your retirement account, in many cases, you're not going to be able to benefit from it. There are exceptions to the rule. I'm not going to get too much into it, but that's something for another time. We're going to talk about any individuals, but when there is a partnership, when there is a corporation or the partnership, an LLC, a syndication, the depreciation is usually allocated according to percentage of ownership. So if everyone invests a certain amount and then they're going to get whatever percentage of ownership they own, they're going to get the depreciation. So simple example, let's say 10 people come together and do a joint venture and each invest $100,000 to buy $1 million property. So it's all cash. When the depreciation comes, they're going to get 10% of that depreciation, each one of them. So in the case where we talked about $1 million property earlier, where there was a $238,000 deduction, so each one of those partners would get $23,800. That's simply put, that's how depreciation works. Now, remember, I said earlier that depreciation is based on the purchase price, not how much money was put in. So if these 10 partners, instead of buying it all cash, took out a loan for 75% loan to value, and instead of buying $1 million property with their $1 million, they can now buy a $4 million property. That's the power of leverage. Not only that, now their depreciation is going to be, instead of $238,000, multiply that by 4, and that's how much? Anyone doing the math? I'm not that good at math, believe it or not. It's $952,000. So instead of getting $23,000 from their $100,000 investment with the bonus depreciation, they would be able to get $95,000 in the first year. So that's where a lot of you may have seen investments and talking about, we're going to get 100% of your bonus depreciation of your investment is going to come back as a tax deduction. That's where that's coming from, where there's high leverage and it's a high level of cost segregation. So that's a simple strategy in terms of depreciation, how you can do it, how you can maximize it. The higher the leverage, the more depreciation per dollar of investment. We talked about the real estate professional status, and the reason why this is so important, okay, and I'm going to break this down, is because real estate is considered passive income. And when you make money in real estate, the IRS treats it as passive income. It's going to be your Schedule E, which is different than your Schedule C or any other types of income. Schedule E is considered passive. Now, Andrew asked earlier, what other types of passive income there are? Unfortunately, what we may consider passive is not what the IRS considers passive, right? And a lot of us don't consider real estate passive either. Nevertheless, it's treated as such. Stocks is not considered passive income. It's considered portfolio income. It's treated differently. However, royalties or a passive business interest. So if you own a percentage in a certain business, but it's a passive role, then that would also be considered passive income. In all those cases, that's considered passive income. Depreciation can only be used to offset passive income, unless there's a few exceptions. We're going to talk about 3 of them today. The most notable one is what's called an active real estate professional or real estate professional status, REPS. You may see that, REPS. You may have seen that come up a lot in social media and stuff. REPS, REPS, real estate professional status, means, according to the IRS, that you or your spouse, okay, so only one of you needs this status in order to qualify for this. You are 100% of your, sorry, not 100%, 50% or more of your time is in the real estate trader business, meaning you cannot have a W-2 and also qualify for the real estate professional status. It's impossible, according to the IRS. Even though there's a couple exceptions, it's virtually impossible. Now, not only do you need to spend more than 50% of your time, essentially your full-time job is in real estate, however, you also need a minimum of 750 hours, meaning you can't just retire and sit on the beach and not do anything. You actually have to have some material participation in working in order to get this status. Now, what is considered a real estate trader business? If you're doing any of the following, again, these are the words of the IRS, just formatted differently on my page for your viewing pleasure. Developing or redeveloping, constructing, reconstructing, acquiring it, converting, renting, leasing, operating, managing, or brokering real estate. Now, if you are a real estate broker, anyone here on the call, a real estate broker or agent, realtor, just put in the chat, yes, me, right in chat, open the chat, say hello, say ask a question. See if you're still watching, anyone's paying attention. Anyone a realtor? Okay, so if you're not, if you are a realtor, I should say, then you automatically qualify as a real estate professional. However, the benefit of the real estate professional status is if you own rental property, because as I mentioned earlier, Depreciation and cost segregation can only be used to offset passive or rental income. However, if you are a real estate professional, it's not limited to that, meaning you can get a cost seg study and then use those deductions from a cost seg to offset any other source of income. And I'll just give you a quick example of a client of mine who came to me years ago, who was a very successful realtor who owned a brokerage in California, one of the biggest. He was the number one broker in the county. Okay. And so he was doing well, making seven figures, and was paying huge amounts of taxes. He also invested in real estate, but didn't know about cost seg. He actually read the book Tax Free Wealth from Tom Wheelwright. I highly recommend that. Great book. And he learned about cost segregation and then, Googled it and found me and reached out. And he was like, what's this cost seg? How can I use this? He had just bought a multifamily property back then. I think it was like $4.5 million or something like that. He bought it for. And he was able to, from that, take the bonus depreciation of over $1 million from that property. All right. So he was able to get from a $4.5 million property, he was able to get over $1 million of bonus depreciation in the first year and completely wiped out his tax liability. So he went from going in California, a very high tax rate. He went from going to pay from paying over $300,000 to the IRS to the next year paying zero. So that's the power of being a real estate professional, because again, it wasn't just the income from his rental property, it was the income from his business, from his broker fees, etc., that he was able to offset. The second exception to the rule is what's called a passive real estate professional. And this only applies to someone who makes less than $100,000 of adjusted gross income. So if your what's called Maggie adjusted gross income is less than $100,000, you're able to use $25,000 of your depreciation to offset your active or your W-2 income. If you make above $150,000, you cannot take even a dollar of passive deductions against active income. Okay, so it phases out between $100,000 and $150,000. That's the second exception. The third exception to the rule, and I hope everyone's following, I'm kind of talking fast here, but just want to make sure to get everything in, pack it in, give you as much value and information as you can. You can always go back and watch these recordings if you missed anything or ask questions along the way. So the third example or exception to the rule is what we like to call the short-term rental loophole. We put it in quotations, loophole, because it's actually directly in the tax code. So it's not something outside. It's not really a loophole. We call it a loophole in quotations because when the law was written, it was before Airbnb existed. And so it was not necessarily intended for the purpose that it's being used today, but it's directly there in the law. And the law says as such, if you own a short-term rental, which means the average stay is less than 7 days, so a traditional short-term, not mid-term rental, and you meet material participation requirements, which there's 7 of them, but we're going to talk about the 2 most common ones, is you either spend 500 hours on the property or across several properties if you own several, or you spend 100 hours per year and more time than anyone else. So in the chat, anyone here own a short-term rental? Just write yes or STR in the chat. Just like to know if anyone owns a short-term rental. Short-term rentals are a very, very powerful tool because if you meet these 2 requirements here, again, 7 days or less, and you're self-managing it, that's the important part because you're spending more time than anyone else, or 100 hours, 500 hours a year, you can use this to offset your W-2 income. Okay. There are almost no other examples like this where you can use depreciation to offset your active income, even if you have a W-2. So this is huge. I know hundreds of people who have used this strategy to literally wipe out their W-2 income, just having a couple or 1 or 2 or 3, whatever, short-term rentals is the way to go. Now, obviously it's a business in of itself, so it may not be for everyone, but definitely something to look into if you're looking for ways to reduce your tax liability. Now, I know we're talking about multifamily here, and multifamily syndications specifically, but this is really important because, it may be for you. This may be a way to, in the meantime, especially if you are still full-time in your job, to actually offset all of your active income as well. The Tax Cuts and Jobs Act of 2017 was actually the biggest tax reform in about 4 decades. And what this introduced was a law called 100% bonus depreciation, which, interestingly enough, let's talk about what the law said before the interesting part. So 100% bonus depreciation says once you've done a cost segregation study, you can then allocate, those 5-year and 15-year property faster depreciation. You now can take 100% of those deductions in the first year. So instead of spreading them out over a 5-year period, which again is great, but in our example, let's go back to our example over here. Yeah, remember this one? So if you had $170,000 of 5-year property, that means you can spread this over a 5-year period. Now that's great. Getting a 5-year period, that means you'd be essentially getting $65,000. Is that right? Is that right, math? $60,000, $70,000. I don't know. Anyways, you get what I'm saying here. 170. $50,000 a year. Something like that. Okay, I'm totally messing up. Anyways, you're getting extra deductions over the first 5 years. However, that if you had the opportunity to take that as a lump sum in the first year, that's what 100% bonus depreciation says. So instead of doubling or tripling your deductions, we're getting a huge lump sum in the first year. That actually was only when it was written into law, between when it was written in 2017 through the end of 2022. In 2023, it went down to 80% bonus. So if you bought a property, and it's important to remember, it's based on when you bought the property or placed it in service. So if you bought a property between 2017 and 2022, you can claim 100% bonus depreciation regardless of when you're doing your taxes. If you bought a property in 2023, you're only eligible for 80% bonus, which means 80% of those accelerated deductions you take in the first year. The remaining 20% can be over those faster 5 and 15-year categories. And if you bought a property this year in 2024, you can take 60%. So it continues to phase out. Next year it will be at 40, and then 20, and then 0. However, right now, as we speak, there is a law that was passed by the House in a tax reform, I guess, a certain bill that's in Congress right now, and there's a vote next week on the 29th of January to vote on whether, I think it's called the Family Reduction Act, something like that, which is going to reintroduce 100% bonus depreciation, not only to retroactively for 2023, but also for 2024 and 2025 as well. So reintroducing 100% bonus depreciation will be a huge thing. I think it was great for the economy. It really did a lot for real estate investors, obviously. And it'll be great to see if it comes back. So everyone keep your eyes out for the news in the next week or so to see if that is included in the bill in its current form. It is, but we'll see what happens. Any questions, guys? Any questions? We got a lot of people here, and not sure if you guys are asking any questions, but please do. Now, when is the best time to get it done? A common misconception is that you need to get cost seg done in the first year of ownership. Not true. You don't. You can get it done really at any time, which is interesting. Although most people like to get it done in the first year after the acquisition, we actually run a free estimate, a free feasibility analysis for any property. So a lot of people especially syndicators, like to get that done even when they're under contract because they want to be able to raise money. They want to be able to show people. I'm not sure why exactly, because again, there's limitations to who can use the bonus depreciation, who can use those depreciation deductions. But nevertheless, people like to show, if you invest with us, we're going to get back X amount of depreciation. So that can be done before you buy the property. The only time your depreciation changes is after you do a renovation. Meaning, if you bought a property for $1 million and then next year it went up in value and it's now worth $2 million, unfortunately, that doesn't change your depreciation. Depreciation is set in stone from the time you place it in service and never changes. However, if you put more money into the property, if you do capital improvements, you do a renovation, you can then depreciate those dollars and do a cost segregation on the renovation as well. So it can be done in 2 stages. However, as I mentioned earlier, you can do what's called a look-back study, which allows you to capture depreciation on a property you may have bought 5 years ago. Who knows? You never did cost seg, you can do it now. And instead of amending your previous year's tax returns, you don't need to do that. We're just going to catch up whatever missed depreciation there was and apply it this year going forward. So a really important thing to know, you do not need to do cost seg in the first year of ownership. And in fact, because of the tax strategy, it really should be done in the best time that is good for you. Okay. How are we doing on time anyway? Any moderators out there? And how long is our session? Because I think I have it for half an hour.
It'll take 1 or 2 minutes,
Sorry, 2 minutes?
Yeah.
Okay, so we're going to rush through these next couple slides. Any questions? No, let's cover one more thing because I'm going to skip the case study But feel free to reach out for me for these slides afterwards. Just want to show you different properties. Obviously, mentioned apartments are at a average 28% of that could be depreciated at a faster rate. But I do want to talk about recapture very briefly. This is something a lot of people don't talk about, but it's important to note recapture tax is something anytime you sell a property, you're going to be subject to this tax. It does not mean that you pay back depreciation. Very big misconception. You're not paying back anything. All you're doing is being subject to a tax. And there's a big difference between being subject to a tax and paying the tax. Okay, I want you to write that down because it's really important. Subject to a tax means, okay, you have a tax liability, but paying the tax is only after all your other deductions. So there are many ways to defer or offset that. Because we're running out of time, I'm not going to get to all those things. I do want to just bring up my information here. If anyone does have any questions or you do want to reach out to me, please feel free to take a screenshot here. If you're not following me on any social media already, please do. And just make sure instead of just hitting that follow or connect button, take 10 seconds and write a little note that you saw me in the multifamily AP360. And I'd be very grateful. And grateful to Rama for hosting me. You guys are awesome. Keep up the education. Keep what you're doing. I guess there's no questions. So that's all we got.
Yep. Thank you. There is one question from Andrew. I think you already read that one.
We did cover that, yeah.
Yeah. Yeah.
All right, perfect. And I think our next speaker has joined.
Yeah. Yes.
Zach, good to see you, buddy.